Good morning, everyone. This is Kirk here again at Option Alpha. This is the members only video update for January 20th. So, a lot to get to today. I know I've been fairly dormant on the trading area for the last couple weeks here, and I think that's okay. I'm actually okay with that. I've said repeatedly that I'm not going to force any trades into the market. I think we're getting to a point now where we could be in a slow melting grind higher. So I think it's prudent to at least start adding positions. January was good. Everything we had on as far as positions are going to expire profitably, so that's great. We just didn't have a lot of positions on it, and that's okay. Again, slow, consistent, conservative is what I aim for, and last year's returns really show that. So what I wanted to look at today are two things. I wanted to go over just some technical stuff first, go over our trade and why I'm going to go on the put side today, and then also wanted to show you guys a look at a back spread, because I had mentioned before that getting into some sort of a put back spread, a ratio spread, whatever you want to call it, I think might be a good idea if you have the capital. I think it's a really good risk reward, and it's definitely plays to the market right now about the possible direction with low volatility right now and just a slow grinding melt higher. So as we take a look at just a couple things, I mean, there's really so much I could look at. I tend to look at option buyer sentiment, put call ratios, that type of thing when looking at market sentiment and where we're at. Some sentiment indicators are higher than others. Some put call ratios and volume indicators are higher than others. But I like this one, the option buyer sentiment gauge. We're not quite at the bullish extreme yet, which is why I'm hesitant to add, I guess, a call spread or any type of a call position. In fact, I think I'd even say that most of the credit is due to the people I've talked to recently. Some guys I talked to last night, really kind of drove home the point to me that maybe I didn't see before, that, I think that on the call side, even though I was going to get far enough away, there's no point in entering that right before the market continues higher. So I think on the put side, what we're going to do is enter this put spread. But if we get a turn in the market, you better believe that this thing is coming off ASAP, and we're going to be flipping our positions to more call spread type options. So just be aware of that. This is a position that's fairly close for my liking overall, but it's what we have to do in the given market environment. So if you look at option buyer sentiment, again, it's not really as high as it could be as far as a bullish extreme. Now, it's not at a bearish extreme either, so that doesn't mean that we've necessarily bottomed out or started to continue lower. So again, it's just right in the middle of the trend. Put call ratios on equities, again, same thing, right? So we're not at a bearish extreme. We're heading towards a bullish extreme, but we're just not there yet. It's nothing close to what we had in May and June of last year, or of 2010, 2011. So that's not to say, again, that we can't fall from these levels. Again, back in May and middle of summer, really, in 2011, we got down to basically the same level here as far as a put-call volume ratio, and that's where we started to have a real sell-off. So again, we're not at the technical and quote-unquote extreme yet, but we're getting there. We're definitely heading in the right direction. When we take a look at the actual chart, so back over on my Thinkorswim platform here, you can take a look at the VIX. This has been the main driver of just low premiums across the board. The VIX finally cracked into the teens the other day. I think when I look at the VIX, the best indicator I've found is these acceleration bands, which I have on here, which are set to a 20 period, by the way, in case you want to set those. But once the VIX breaks out of those accelerations to the downside, you can see it's only a matter of days before it comes back in. Now, it's important to note that it's just got to come back inside the acceleration bands. It doesn't have to go higher. You can see when I did the video just for members last month in December where I showed the break outside of the acceleration bands, it in fact did come back inside those bands, but the bands just happened to move lower. So was it really a move back inside? Was it really not? I mean, on a technical basis, it's back inside those bands, and they're really condensed now. But I think that's the key thing to look for. If we start to see the acceleration or the VIX again break out of this in the middle of a downtrend, I think that's where we'll start to see some topping forming on the charts. If we take a look at the RUT, which is what we're going to trade today, it has been a little bit more sold off than everything else, and therefore it's just starting to come back into an area of resistance. So you can see that this line here at roughly 775 on the RUT, that's really the main area of resistance for the RUT. Most of the other indexes have already broken this relative resistance area. The S&P is probably up in this range, relatively speaking. So the Russell has got some moves to make if it's going to break out. If it continues this breakout, it's definitely got some upside potential. When I was looking at call spreads, I was looking up in this range, the 850, 860 range. So it's not that I wasn't leaving enough room, because I think that on a call spread, I think we could still have plenty of room and get some really good premium. The 850, 860s were trading yesterday around $45 to $50 a piece, which is great for that type of spread. But I think that going down here to the 660 level and shortening up our differences between our strikes, so only a $5 difference between the strikes versus a 10, I think it's going to be prudent. But again, like I said, if we start to see this trend reverse and at least the market get down into the 660 level, 760 level, 750 level, then you can better believe that this is either going to be coming off or be hedged, and we're going to go back up here to this level. So it's going to be a quick maneuver, and I think that it's the best way to play this market right now, to enter positions below the market. If it's going to grind higher to sideways, then we're okay with positions below the market. But if it does turn, then prudence suggests that you take this off fast for risk management and get a position away from the ensuing trend. So as always, I'll keep you guys up to date on that as far as the daily analysis. And if it does change or move, then I'll obviously send out updates and videos and commentary, etc. I think that everything else for the January expiration today is going to be good. The RUT, we had a call spread, that's 830 area, that's going to be good. SPY, we had a position in, that's obviously going to be good. And I think that was really it. I don't think that we had anything else. IWM. For the DIA, just want to take a look at this real quick, and let me get these acceleration bands off here. They're driving me crazy. So for the DIA, take a look at this. This is the trend line break, and I've actually had this up for months and months and months and months. I've had this trend line up since it broke here. And you can go back in all the video commentary and watch it, but this is pretty interesting how you can just see that we're still not above this trend line, even though we're higher than the break. And I guess in a really weird situation when you look at technicals. But even though we're higher than the actual price level of the break, we're still not below or above this trend line yet. We're still on a retracing pattern, and we've gotten closer and closer, and we've got rising lows, right? That's a good signal. So maybe it'll only be a matter of time before we break. We're also at a very key level just across the board on the top. So it's going to be an interesting couple of months in this first quarter to see where the markets go. Now let's get into just to take a quick look at the put back spread, as I was talking about. So here's the problem with this type of market that you have. And let me go over to the put back spread so you guys can see it. So the put back spread is really designed to potentially profit in both directions. And I say potentially because you have this gap or this void. The idea with the put back spread is that you leave some premium across the board should the market continue higher. So the market right now is right here where my X is drawn on the chart. Thinkorswim cleverly gives a dotted red line. So what I've done when I created this put back spread is that I've given room between the two positions that I'm buying and selling to leave about a $200 credit. So you can see that's my credit down here in the bottom. I'm getting $200 right off the bat. So if the market continues to float higher, can even drop down as far as 700 really, then you're still going to make your $200 credit. That's the good thing with the put back spread. So you're kind of sacrificing some of that credit for the ability to do this, which is to create this extra long position on the bottom side, this extra long put. So you can see down here that I have I have one extra 670 put in this particular example. So I'm short 2 and I'm long an extra 1, so long 3. What this does is it gives you more of a positive tilt toward volatility. So should the market continue higher, great. You still keep your $200 credit. But should the market really drop, and that's what I'm always concerned about with markets that kind of float and melt higher here is that we could see a dramatic increase in volatility and we could see a dramatic drop in the indexes, similar to what happened in the summer where the indexes dropped a couple hundred points in a matter of 8 to 10 days. Now what this does is that it gives you this extra long position. So if the market does drop, then you're actually tilted towards a bigger drop. So either you want the indexes to melt higher or you want them to really collapse. And that's really the benefit of the strategy. What you don't want to happen is that you don't want the indexes to kind of do a slow grind lower. That, if anything, is going to be bad, but you can always get out of the position, take the credit off the table, and make other adjustments by adding more puts, etc., etc. But what you don't want to happen is that you don't want the index to make a slow grind lower and then close within this gap here. Again, I think it's a really good strategy to take a look at. We have video tutorials on it on the dashboard, which I've linked to in this post, this trading alert post, but I think it's something that you should definitely add to your analysis, maybe even paper trade it and take a look at it, see how it acts. If you've never traded it before, absolutely paper trade it. What do you have to lose, right? Another thing you can look at. So hopefully this has been really good for you guys. As always, I hope you guys enjoy these videos and the trading alerts. We'll always update everyone with comments on fills, adjustments, etc. right below this trading alert in the commentary section. So if you have questions, please enter them there. That's the best place so that everyone can see the same questions. I don't get asked duplicate questions in email. As always, hope you guys enjoy and happy trading.